Georgia has a terrible housing affordability problem. That is exactly what we are going to look into today. With sky-high home prices, crazy mortgage rates, and inflation, it is easy to wonder if you can even afford to buy a home today. I am seeing way too many people struggle with affordability, and it is so frustrating. So, I'm here to give you the real scoop to help you make an informed decision. This is not one of those buy a house at any cost video, so don't sweat it. I wouldn't do that anyways. I'm here to give you the real deal. In this video, we'll talk about real numbers, what you need to do with your debt, and how much do you need to save up for that all-important down payment on your home. My name is Hasna Pierce, your local realtor here in the Metro Atlanta market. I got the skinny, I got the scoop, and I have all the information regarding all things real estate. I put out videos every single week answering questions that you are asking and sharing information about buying and selling a home in this market here in Metro Atlanta. All right, let's get to it. The average salary in the US right now is about $64,000 a year, according to the recent data from the Social Security Administration. And Georgia, as of the recording of this video, is a little under that. Can you actually afford a house with that income? The short answer is it's not impossible, but it's definitely tricky. First things first, before you even think about talking to a lender, you need to take a good hard look at your finances. I've got a little exercise for you, something that will open your eyes and give you a clear idea of whether you're ready for this next step. Let's talk about the 28-36 rule, which lenders use to see if you can actually afford a mortgage. It is really more of a guideline than a hard and fast rule because many types of mortgages are available today that allow debt levels that exceed the 28-36 rule. I always advocate for you to be conservative, and following this rule can help ensure that your monthly mortgage payment is affordable for your budget. Here's the quick math using this rule. No more than 28% of your gross income should go to your mortgage payments, and no more than 36% should cover all of your debts. And when I say debts, I'm talking about credit cards, car payments, student loans, the works, things that you would consider debt. So let's look at it closely. If you're making $64,000 a year, that's $5,333 a month. 28% of that is $1,493, but let's round that up to $1,500. That's the max monthly mortgage payment, which includes principal, interest, taxes, and insurance. Now, in regards to the debt, 36% of $5,333 is $1,920. Again, that's credit cards, car payments, medical bills, student loans, etc., etc., etc. That is the most you should be paying towards your debt. Do the math on your debts and you'll know where you stand. If your debt is already at $1,900 or more, it's time to pump the brakes and start paying it down. You are going to have a hard time finding a lender to qualify you for a loan if you are over that amount. Now let's get even more real. You might be pumped about the $1,500 mortgage payments, but remember, your net income is usually around 80% of your gross. That leaves you with what? About $4,200 a month? After mortgage and debts, you are left with about $850 for everything else. Groceries, bills, your phone plan. If your debt is near or over $1,900 a month, it's time to get serious about paying it down. Maybe trade in that newer car you have for something a little cheaper. I know I sound like Dave Ramsey right now, right? But this is the reality. If home ownership is your goal, you've got to do what it takes to get there. Yes, I hear you, and I do understand. With a max of $1,500 a month mortgage payment, are there even any homes that you would like or that would meet your family's needs? Let's see what's out there in Metro Atlanta. From $150,000 to $200,000, you'll mostly find condos and townhomes. For example, in Metro Atlanta, there is a 3-bedroom, 2.5-bathroom townhome for $200,000, or a condo for $149,000 with 3 bedrooms and 2 bathrooms. Not bad, right? But don't forget about those HOA fees. Usually, condos and townhomes do have HOA fees, and they'll add to your monthly costs and could push you over your budget. Next, we are going to talk about credit score and down payment. Typically, lenders tend to look for at least a minimum of 620 credit score for you to get a conventional loan. Some may be higher, but 620 is pretty typical. For an FHA loan, we're looking at 580 as a minimum credit score. So what I would do is to make sure that you check 3 main credit bureau to see where your credit score is. Typically, what a mortgage lender would do, they would throw out the highest, they'll throw out the lowest, and they'll go with the middle score as your true score before they can move forward into determining whether they are going to be able to offer you a loan to purchase your home. Now, as far as down payment, once you got that debt under control, you'll want to start saving for your down payment. We are looking, probably putting down a 20% down payment. I know that number is a scary number because we are talking about $40,000 on a $200,000 loan. Some lenders do have access to down payment assistance program that will certainly help you. You can put down as little as 3% with some conventional loans or 3.5% with an FHA loan. Just remember, less than 20% down means you'll be paying for private mortgage insurance, and that will bump up your monthly payments. Not to mention taking out a higher loan amount, which will also bump up your monthly payments. If you're dead set on buying a home, do your homework. I will be happy to help getting you pre-approved and looking for homes that fit your needs. But most importantly, use the 2036 rule to see if it's even possible for you. It's not all doom and gloom. If you stay focused, tackle your debt, home ownership is really within your reach. As always, thanks for hanging out with me today and getting your dose of real estate reality.